Hello, everyone. My name is Sunday. I welcome you all to Against FX. Yes, today we're having a very interesting topic. All right. And the topic is multi-time frame analysis. Multi-time frame analysis. All right. Remember, if you have not subscribed to my YouTube channel, please do subscribe because this is a free course. More than a month. All right. I told you guys I'm going to when I started, all right. I told you guys starting from that day till the end of this month, September, all right, that I'm going to teach you guys how to trade for free. And the only thing you can do for me is just for you to subscribe to my channel, activate the bell sign, and after you have watched the videos, take note. Make sure you take notes. All right? Jot something down. It's not just all about watching the video like you are watching Africa My Magic. All right, just like movie. No. This is something that will better your life. I promise you that. But you must have this passion, this zeal to learning. All right? Because this is a course that you need to learn. You need to study it. All right? So please, once you have subscribed, then all you need to do is go to my playlist. Go to the playlist with this name, Beginners Free Course. That is where you see all the videos. All right, that's where you see all the videos in sequence. You see them. And we have enough materials there in there now. So when you start watching the first video, second video, just like that, like that, like that, before you know it, from the comfort of your home, you will just grab the concept of how trading works and you will just be trading. It's like that. We are now in computer age. It does not necessarily mean that you have to go to somebody, go and meet somebody, let the person teach you physically. No, it's not. We are in computer age. It's 2025, guys. So that being said, make sure you share the videos, like and drop comments. All right. And I told you that any video that you watch, please drop a note, drop a message, drop a comment and share it. Let me know what you were able to grab from that video. And if there's something that you need me to still throw more light on, please drop it at the comment section, please. All right. So that being said, today, like I said, the topic is multi-time frame analysis. All right, before we proceed, please, this is a free course. It's a free course. You are not paying for it. All right? You are not paying for it. The only thing you need to do is subscribe to my channel. Then you have full access, all right, to the video. All right. Even if you did not even subscribe, you still have full access. But it's better, all right? Just do me that favor. Subscribe and activate the bell sign so that anytime a new video is dropped or uploaded, you'll be the first to be notified. So before we continue, please share the video. Please share the video. I need your comment. As you watch, don't just keep quiet. This is information that we are sharing. So once you watch any particular video, then pass it to another person by sharing it. All right? You never can tell because most people are out there looking for the opportunity to key into this kind of training, but if they don't know, the thing will just pass them by. And it's never too late because all the videos are there. All right? So that is the reason why you have to share the video. Share. Once you watch, you share. All right? Drop your comment. And as you do, God bless you. So time frame theory. We need to know time frame theory. All right? The time frame theory is all about how traders interpret price movement over different period of time. How traders interpret price movement over different periods of time frame theory. So it is not just a technical detail, it is a strategic lens that shapes how you see the market and make decisions. All right? It is a strategic lens that you use to shape how you see the market and for you to be able to make decisions. Because there are people, they will open their chart, they will read it upside down. And another person will open the same chart and another person will now open the same chart and read another different meaning to it. That's why you see, at every point in time, once you do your analysis, you now want to take decision either to buy or to sell or to stay out. Then if you now decide to sell when the market is in a buy, that means you just be shooting yourself on the leg. All right? So it's not proper. So you need to know how to read market structure. All right? Very, very important. Very, very important. All right? Now, what is time frame? What is time frame? All right? A time frame refers to the duration each candlestick represents on a chart. The duration each candlestick represents on a chart. For example, we have 1 minute, M1. M1 is 1 minute, meaning that each candlestick shows 1 minute of price action. Each candlestick shows 1 minute of price action. It shows the information of 1 minute. And each candlestick, now it will represent 1 minute, 1 minute, all right? The candlestick will open in 60 seconds. It will now close. Another one will open. 60 seconds, make 1 minute, all right? After 60 seconds, that is 1 minute, that candle will close and another one will open. So M1, that is the abbreviation, that is 1 minute. Each candle shows 1 minute of price action, all right? Now we have the H1, that is 1 hour. Each candle shows 1 hour of what? Price action. That means when you are on 1 hour, that is H1, all the candlesticks you see, each one represents 1 hour. Once a new candle opens, it's going to continue to, if it's going high, it's going to continue until after 1 hour. Once it's 1 hour, that is 60 minutes. Once it's 60 minutes, all right, it will close. Another one will open. All right. Then we have the D1, that is daily time frame, the daily time frame. Once you click on daily time frame, the chart will open. All right. Each candle shows 1 day price action, as simple as that. Each candle on a daily time frame shows they represent 1 day price action. All right. Then why time frames matter? Why does it matter? It matters because of what? Trend identification. All right. Now, the longer time frames, that is daily, when we say longer time frames, or we say higher time frame, we are referring to daily, weekly, and most time you see the 4 hours, all right? The 4 hours. Then these help spot major trends. Now, longer time frame help to spot major trends. All right. If you open your daily or weekly time frame, if you know what you are doing, you will see, you will immediately ascertain the direction of trend, where the trend is headed, whether it's a bullish trend or a bearish trend. All right. That is where you can easily spot major trends. All right. Why shorter ones like 1 minute, 5 minutes, 15 minutes, all these reveal short-term volatility. All right. They only reveal short-term volatility. All right. Then we say strategy alignment. All right, strategy alignment. Why time frame matter? We say trend identification for you to be able to identify trend. And how do you do that? You go to the longer time frame. Go to a longer time frame. That's daily, weekly, even monthly. All right. Then another one is the strategy alignment. Strategy alignment. Like scalpers use short time frames, like 1 minute or 15 minutes. All right, when we say scalpers, they are type of traders. What do? They are just like traders like you and I, but their own way of trading, their trading style is different. All right. They don't hold trade at all. All they do is, as once they see any opportunity, they just jump in. After maybe 10, 15 pips, they are out. They take their profit. They don't stay. They go in, go out, go in, go out. They go in, go out, wait for another opportunity, take position, close their position. They open position, close their position. That is how they scalping, going here and there. Once they see opportunity, they just capitalize on. And you see, all those opportunities, you see them in 1 minute, 15 minutes, because there is so much noise. All right. So swing traders, they are also type of traders. All right. What they do, they hold trade. They lead to like throughout the day, even sometimes 2 days, even sometimes in a week. All right. And their time frame, one moment, and their time frame is usually H1, that is 1 hour, H4, that is 4 hours. And we have position traders. Position traders rely on long-term charts like daily or weekly chart. So position traders, all these are traders that can hold position for like 1 month, 2 months, like that. All right, so they don't trade on lower time frame at all. They trade the dormant time frame. That is the daily time frame or weekly time frame. When we say daily, that means each candle, like I said, represent one day. Like if it's weekly chart, that means one candle represent 1 week. I hope it's very clear. Then the reason why time frame matters again is for risk management. The purpose of what? Risk management. Shorter time frame is equals more noise and risk. That is small time frame, or we say lower time frame, all right, is equals more noise and risk. All right. Then longer time frame is equal to smoother trends, all right, and more reliable signals. Because the signals and the trend you will see on a longer or a higher time frame, like the 4 hours, the daily, and the weekly, they are more reliable, all right? They are more reliable and very smooth. Once you are able to identify that the push is going up, all right, once you enter, the price will just be pushing. We just say it just be pushing. And until it gets to that level of resistance, or if it's a bullish trend, until you get to that level of support, it will continue to go. All right, just like a movie train. But the ability to spot when the movement will start, that is what makes you a good or professional trader. All right. So why time frame matters? Another point is market noise filtering. Higher time frame reduce false signals caused by random price fluctuation. Because if you are trading on a lower time frame, you just be seeing different signals, false signals and all that, because too many people are there, even those who knows how to trade and those who don't know how to trade. They are just there. So you can imagine going to a mall where it's populated, where we have plenty population, all right? And you want to go and shop there. You should know that as you go to mall, you see plenty people. There will be plenty. There will be population there. Let's just put it like that. Like you not going to mall, all right? You go to maybe just a supermarket, all right? You see that, or for example, let's use private hospital and public hospital. Public hospital, you see massive, plenty people like that. But if you go to private people, if you go to private hospital, there are chances are that you meet just few persons, all right? Because it's not everybody that can afford it, all right? But that is Africa anyway. Abroad, anywhere you go, there is smooth, everything is organized. So it's like that. So market noise filtering, higher time frame, reduce false signal caused by random price fluctuation. Because on the lower time frame, you will see fluctuation, price will going on, coming down. You will not even know where the right support is, where the right resistance, and all that. All right. So that is that. It's always good you trade on a higher time frame. All right. If you want to scale down, make sure you start your top-down analysis from the higher time frame, mark your levels from the higher time frame. Then if you now scale down for you to position, you already know We are going to do top-down analysis in a moment so that you will see it. But anything I teach, I will practicalize it. Anytime, any day, that is how it is done. All right? So you first of all go to the higher time frame, draw your lines, support and resistance. Then you now start scaling down to your time of execution. Like me, I trade on 4 hours. Even if I want to go below 4 hours, that means 1 hour. I don't go below that. That means that 1 hour or 4 hours will now be where you will now execute your trade. But you have to take the support and resistance from the higher time frame. Then you will now refine it. All right? Sorry, you will now refine it. And then we have multi-time frame analysis. This is a powerful technique where traders analyze multiple time frames to get a full picture. All right? You analyze multiple time frames to get a full picture. You start from the higher time frame, then you start scaling down. You start refining your analysis down to the time where you execute your trade. Like I said, me, I don't go below 1 hour. All right? That is top-down analysis approach, top-down approach. You start with a higher time frame to identify the trend, then zoom into lower time frames for entry and exit point. That means you're starting from the higher time frame, then you now refine it down to the time you want, you now choose for your execution. Some people, they use 15 minutes, some use 30 minutes, some use 1 hour, some use 4 hours, some even use daily, all right? Some even use 15 minutes, some use 5 minutes. It depends. But my advice is that if you want to scale down completely, make sure you go to the higher time frame first. All right? Because it's a higher time frame that will decide where the market should go. Because the big boys, the banks, the hedge funds, the financial institutions, they don't come down to lower time frame to offload their orders. They go to higher time frame. All right? So your lower time frame is where you now, once you refine it, that is where you now place your order, your entry and exit point. All right? Example, use the D1 chart to spot a bullish trend, then the H1 chart to find a pullback for your entry. This is just an example that I gave. All right? If you are a day trader, intraday trader, that means you open your chart, you take position in a day, then before the day closes, you have to close your trade. All right? You don't take trade overnight, except maybe there's reason for that. All right? So since you are an intraday trader, you can start your analysis from daily. All right, but that does not mean you should not look at the weekly and the monthly for direction. So once you go to daily, you check to know, okay, it's a bullish chart, it's a bullish trend. Then you now start scaling down from 1 hour, from daily to 4 hours, from 4 hours to 2 hours, from 2 hours, you now drop to 1 hour. Then 1 hour, as you are refining it down, you are following the higher time frame levels. All right? You are following the level. So once you scale down to the time where you do your execution, then you will now place a buy or a sell. Then you now position. And you know that, okay, your positioning now is in tune with the higher time frame. If the higher time frame is going up, your positioning on the lower time frame should be that same way. You are trading in the same direction. So once you do that, you are doing the right thing, guys. So on this note now, we'll now go to the chart, and we'll now go to the chart, and let me do top-down analysis for us to see. All right. Okay. We'll go to the higher time frame, the monthly. As you can see, we are what? Bullish. Why are we bullish? Now we have started doing top-down analysis. So this is how you analyze your market before you take position or before you take decision on what to do. All right. First, you go to higher time frame. And what do you need to do from the higher time frame for you to know the direction? Because looking at this trend now, you know that it's making highs, lows, and highs again. To get to a point here, then it will come back like this. So it shows that we are pushing to the upside. And remember, monthly, that means each candle here, every candlestick here represent 1 month. This candle now that starts, okay, this candle now was last month candle. All right, this is August. You can see from the down here, look at the down here. This one was August. All right, this very one now is now September. This very one here was June. This one here was July, August, this is September. This candle will continue to print till the end of September. Before once October 1st, another candle will now start. This one will close, another candle will now appear. That is what we meant or mean by each candle represents 1 month. All right. This is a price action for the whole month. All right. So we'll just be looking at it, just one candle. But if you scale that, you see more information on this. All right. You can see it. It's very clear. You can recognize that this is going up. Why? Because we have a break of structure here. Let me remove this one. Because we have a break of structure here. BOS, break of structure. And we have, let's clone this. We have another break of structure here. All right. So because of that, we now know, okay, price is going up. That means it's bullish. All right. So where are these support and resistance level? We have one support here. The price got to this point. We have another support here. All right, we have another support there. We'll slow down. So we have one support here, and we have another support. We have another support One moment. We have another support here. So these two here. No, we have another support here, guys. So don't play. We have another support here because this is now what there was a pullback before this push. All right. One support, we have another support here. All right. Then, since we have identified, we've been able to identify that the trend is bullish, and we can see all these support levels. All right. Like I told us, as a buyer, once you notice that the trend is bullish, all you should be looking for is how to buy. The opportunity that you should be looking for is how to buy. But that does not mean you cannot sell within as the trend or as the market is buying. But that one is a little advanced. All right, it's for advanced trader. So you learn first before you start trading against trend. Let's say, for example, I will give it to you. All right, it's up to you. Now, price push from here and stop here. All right. By the time you now discover that it's making a pullback, all right, it's making a pullback, you can enter from here. Then the problem is that if you don't know when the trend will now stop, where it will find support, if you are not able to identify where the trend will find support, before you know it, the trend will now start going back. It will now resume the underlying trend because the trend is bullish. But because you know that it's bullish and you just want to take a quick money because this is a retracement push. After this push, it created a high. Then a moment of relief, the price is pulling back. Then you decide to enter. Yes, people trade that. That means you have to be good before you know that. Because if you stay on this trend for a very long time, you make profit, but when it now gets to a support level where the price will now start turning back to face the upside, all right, for the price to now go and create another high, if you are still there, it will clear you off because you are going against trend. All right, you are going against trend. All right. So the only way you can trade that is when you have already learned how to use Fibonacci retracement tool. I've not taught you guys. I'm going to teach you guys. Then with that, you will now say, okay, if I want to trade retracement, all I need to do is pull out my Fibonacci retracement tool. I know that this trend is going up, so I will start my plotting from the down, put 100, then I will now go and put the 0.00 on top of this one. Once I notice that opposite candle has started printing, once you see opposite candle start printing, okay, this is a blue candle. Once you now see that a white candle, that is a bearish candle, opposite candle is printing, you now know that, okay, this very point is a resistance, all right? That means this price has been established. The next thing you will see for price to pull back. Price will now pull back to what? To a support level. Now, if you are not able to identify levels, because each level here has its own meaning. It has its own significance, what it stands for. All right, I will just rush through it, but I'm going to teach it. It's a topic on its own. Now we have 0.000, right? And here there is a price. We have 23.60, and here there's a price too. We have 38.20, there's a price. We have 50.0, there's a price, and we have 61.80, there's also a price. We have 78.60, there's also a price, and we have 100.00, also a price. And we also have negative 27.00, all right? So what all these things stand from, I will not be able to go and explain into details, so that we will not make this video too long. Even me, I need to rest. I just got back from work. I need to rest, all right? Now, the thing now is that this Fibonacci retracement tool is divided into two. From 50% to 100% is what we call discount level. Now, from 50% up to 0% is what we regard as premium. As premium level. All right? It's very simple. The premium is when you have a higher price, then the discount is when you have a lower price. So the 50 is what divides the both levels. So from 50 up to 0 is a discount level. Then from 50 below to 100 is what? From 50 below is a discount level. From 50 above to 0 is a premium level. And now, the premium level simply means once price get to the premium level, this is a high price. And once the price is established, that is a turning point, meaning that the price will now pull back to a discount level. All right? The price will now pull back to a discount level before it will now rise again. Now, this is where it gets twisted. Each level here, I will now explain. 0.00% is a turning point, a retracement point. That is if the market is bullish. 23.60, all right, is also a retracement point or a continuation. All right. 38.20 is what? This is a support level. Is a support level. 50% is also a support level. 61.8, this is what? A golden level. Most times when price get to 50, if it pulls below 50, it should hold. A support should, this 61.8 should hold the price and now push the price back to the upside. You know why? This is a golden level and plenty buyers. So many buyers, their eyes are always here. They are pending orders and everything. So as price get to this point, there's every likelihood that they will push the price back to the upside. So if you look at this point here, you discover that this price held at 38.20 before it start pushing to the upside. All right? At 38.20. All right? So 68.80 is a golden level. 78.60 is also a support level. Their price has no business pushing below this 100 level. If it comes to this 100.00, it should hold. But once violated, just know that there's a what we call change of character. That means market shift will happen immediately. So as price is pulling back, if it stopped at this 28.0 and 23.60, that means that trend it just pull back a little and continue. So that is a continuation of trend. It just pull back a little, then continue. All right. But if a little push to the downside, the 38.20, it's a support level. All right. Once there's a retracement, if the retracement is not that deep, but at least it will be significant, that means if it turns here, it should get to 38, because now this is how professionals trade this. Once there's a pullback, number one, you watch 23.60 because it's a continuation. If the trend is a continuation, that means the pullback will just come touch this 23.60, then start pushing back, pushing to the upside. Anything that makes this 23.60, this level, fail, that means it's going to push to this 38.20. And anything that makes this 38.20, which is a support level, if it fails, that means the next level will be 50.00. And once it gets to 50.00, if it fails again, then this golden level price will come there. And if you don't see any reaction, that is how you continue to look at the price as it's going down. All right? Until you see a reaction. You see this one here? Let me remove it so that you will see it. You see what happened here? There was a big rejection here. Immediately it got here, it did as if it has broken below 38.20. But the fact is, it closed exactly that level. It only pushed below. All right? It pushed below it, but it got rejected. It did not get to 50. It got rejected. The price got rejected, and it now closed look at it, 38.20. Then another candle now opened. It now started pushing to the upside. So that is how I will make a video so that I can, because Fibonacci retracement tool is a topic on its own. Then this negative 28, 27 is usually where you take your profit. So once you plot like this, all right, if it holds here, that means your target should be here. Even though sometimes price will tend to go above it before you now start pulling back. But as a smart trader, you need to take your profit at negative 27 or just negative 27. Let me stop it there so that you guys will not get confused. So that being said, that is how it is. Now we have been able to mark our monthly level. All right, our monthly level. We see our break of structure, break of structure. This is the last break of structure, and this is the last support level. This is the other support level. So we now need to scale down to weekly. It then means that this weekly chart, meaning that any candle you see here represent 1 week. Have I made it very clear and simple? Each candle you see, this very candle is 1 week. This small candle is 1 week. This, no matter how small the candle is, each candle you see here represent 1 week. Even this dodgy candle here, this small candle you see here, represent 1 week candle. It was like this till 1 week elapsed. So it's like that. So now we have started refining our analysis. You see, we started from the monthly time frame, and we have identified that the trend is bullish. And if you look at it on the weekly, it's still the same thing. It's bullish. Yes. Okay. So, and this is where we mark on the higher time frame. That is the monthly. You see, this is support level. This is support level. All right. So, and we have a resistance level here. Let's mark it so that this is a resistance level. All right. So at this point now, all we need to do is just do a little adjustment. Then we need to scale down. Not much to do. We need to scale down. This is daily now, meaning that each candlestick here represents day, represent 1 day. And you can see the information here now is getting very exciting. All right, look at it. This was the first support level. This is the second support level. You agree with me? Okay. Now, you cannot place your trade here because it's too far. As a day trader, you need to go to the last support level. All right? You need to go to close to the last support level. All right? For you to take your trade, for you to look for an opportunity rather. Now, we'll now start marking our daily time frame. What happens? That I'm now teaching you guys how to do top-down analysis. All right? Remember, this was the first support level on the monthly time frame. All right? Then what we now need to do is we now start reading the structure. All right? This here, there was a break of structure, POS. Anywhere you see break of structure, anywhere you see POS, that is what we call break of structure. Now, this one here is the last low. After this break of structure, price pulled to the upside, all right? Came back, pushed to the upside. Now, this here is our resistance. Remember, anytime price break above our resistance, what do we say it will happen? But what will happen? Okay, if you know it, please drop the answer drop it on the comment section. Anytime price now started pushing to the upside, because if you look at this leg, this is bearish, even though this very one is bullish. All right. The last resistance was here. All right. This was the last resistance. This one here. All right. We got price made this, created a resistance here, pulled down, created a low, pushed to the upside, created a high. This is a resistance, pushed to this point. All right. Instead of price pushing to the downside to create another new low, it did not. It now stopped here. Then what did you now see? Price now push above this level, all right, violating this resistance. So, and in our videos, we said when we treated structure, how to restructure, we said anytime there's resistance violation, when price is coming down and it now turns and starts going up, all right? Once it creates support, that is the downside, and it now gives you a resistance, the upside, then the next push should be price creating a lower low, a price giving us a new lower price. But it now failed. It did not give us a lower price because this price is lower than this. This price here is high. Now, if we want to target in a, let's put money, all right, so that we will understand. Let's say at this point is $20, all right? Price now push to this level, and it gave us, when price pushed to this level, it gave us $50. You see, from 20, it now pushed to a resistance, it gave us a new price, $50. Now, remember what I taught you guys about order flow. Price now supposed to give us another lower price that is lower than 20. Maybe it's supposed to give us like $10 or $15. All right, provided the price is lower than this price. But what now happened? What now happened, guys? Look at it. Price now gave us, price action now gave us $30. Price action now gave us $30. Once you see something like this, just know that something is about to happen. Because as the price is going up, before you can confidently say that, okay, this trend is about to change to become a bullish trend, you have to wait for this $30 to now go higher to violate this 50. Once it gives us $60 as it's going up, once it gives us $50, $60 or $65 or $55 or $60 or $70, just know that this is a violation. And once that happens, will simply mean that this point will now be referred to as what? If you know it, please, I want to be seeing your comment. Market shift or change of character. And once this is done, the next thing you will see, price will go up, come a little continuation. It will go again, give us a new price, come down, go again, give us a new price, come down, like that. All right? Oh, guys, if you know how to trade, that means you will know how to analyze markets. The first thing you need to learn, please, is how to analyze market. We like to analyze structure. All right? That is analysis of structure. All right? You need to be able to carry out top-down analysis. If you don't know how to do that, you need to be able to read structure. All right? Anything that is happening, you should be able to know what is going on at every point in time in the market so that you now know where to stand. You can imagine you placing your trade here thinking that this guy now is going, that is that is supposed to give us a new low. You are right based on your structure, because price move, it created a resistance, it dropped, it gave us a new low. It created a resistance. This resistance did not violate this level. Yes, you are right. It's supposed to not push down the order flow. It's supposed to come and give us a new price. All right? But from here to here, you have made money, profit. By the time you now discover that there's a rejection here and it's holding, this one now closed. Seeing this candlestick anatomy telling you that there are buyers in the market. After the rejection, then you now see this kind of candle, this bullish candle now appear. This bullish candle, this is an engulfing candle. It now engulfed this one. What did I teach you guys about engulfing candle? Engulfing candle simply means that there's a buying pressure. All right? These buyers, they have engulfed the sellers. So that means that buyers are in the market. They are now more than the sellers. All right? So immediately you see something like this, you take your profit. No matter how little the profit is from here, you've been making profit now. If you are smart, you've been making profit. No matter how little the profit is from here to this point, if you have already entered the market, all right, you are not wrong. You did the right thing. But once you see something like this, this week, all right, this week shows that there are buyers in the market. They are rejecting the price from this level. All right. Once that happens, you see they succeeded in rejecting the price from here, and the bullish engulfing candle now appears. They were not able to push the price, and this bullish candle now engulf this bearish candle. That means buyers now, they have overpowered sellers, and price now started going up. Once you see something like this, you take your profit and now wait. That waiting now is for you to now see whether this push to the upside will now violate this resistance level. Because the order flow, as we are in a bearish market, is bearish at this moment, is not supposed to alter the order flow. Altering the order flow simply means pushing back to create resistance. Is either it creates, is either it gives us equal price or double top for price to now start coming down again. That means this point now, this level will now be used as liquidity to now fuel the push again to the downside for price to create another new low. But once you see that this level has been violated and price is going up, forget it. Change your bias. Just know that bearish trend has ended. Now, what you will now be looking for is for price to retrace, which it did here, for price to retrace. What is retracement? Is for you seeing opposite candle. It's been pushing to the upside, seeing opposite candle. For retracement to be valid, I'm going to treat retracement. It's another topic on its own. For retracement to be valid, there has to be more than one opposite candle. More than one opposite candle. Like this one candle here, it just means that, okay, somebody just took, people just take profit and all that. But for for a retracement to be valid, there has to be two opposite candle, more than one opposite candle, guys. More than one opposite candle. All right, more than one opposite candle. That is a real pullback. That is a real a standard retracement. If it's just one candle, but it can be one candle, but a very big, long candle. Okay, that one is acceptable. But if it's just a small candle, one, no. It's just that maybe some people just, because of fluctuation in the market, fear, they just decide to take profit. That's why you see a little drama there. Price will now start with. But once you see two opposite candles, just know, okay, this is a pullback. And once the pullback has ended, then you will now take your position and start pushing the price to the upside. So now, that is for those who trade support and resistance, all right? So if you like, our strategy is what? SMC strategy, smart money concept strategy. We look for order block where institution and financial institution, the banks, the hedge funds, where they place their order. All right, where they place their order, the order block. All right, is what we normally place, what we normally refine. Well, once we identify the other block that caused a break of structure to the upside, because in future, price will still come back to interact with that level. So all you need to do is single it out. You see how we are going to single out another block in a moment. So once you single it out, then you put your pending order. Price will come on its own to come and activate that order. And once that level holds price, then you see a push to the upside. So as simple as that. Now that we have established that at this point now, there is a violation to the upside, that means the trend has changed. That is market shift. Once it has given us a market shift and a little pullback, you now see price. You see, after that, you see price just started going up, like that. So you understand, for trend to change from bullish to bearish or bearish to bullish, there has to be a violation of order flow. And that violation, the only way you recognize that violation is when price gives you market shift or change of character. All right, let's proceed. Then we are on a daily time frame. I told you guys each candle represents 1 day. All right, so at this point, this is the highest price here from the higher time frame, right? Okay, now we now see that we now have another support level here. We have another support level here. All right. So these ones are okay. We have another one support, we have another support. Now we are reading the chart, right? So we say break of structure, then we say market shift. After market shift, we now say break of structure. All right. BOS. Let's clone this. We say here, break of structure. Break of structure. This is a break of structure. We are doing what? Top-down analysis. And why are we doing it? For us to know the direction of trend and for us to be able to look for an opportunity to trade. And what are we doing? We are taking it from the higher time frame, refining it down to where we want to, where we are comfortable taking trades. All right? Maybe you can choose what resonates with you. If it is 1 minute, if it is 5 minutes, if it's 30 minutes, 15 minutes, you can do that. But personally, I don't take my trade below 1 hour. You know, as a matter of fact, 4 hours is better. All right? I don't like noise. So here we say break of structure. Here we say break of structure. If there's any question you need to ask, please drop it at the comment section so that we can respond to your question. All right, so we can now see price breaking structure to the upside, and here is the last break of structure before price giving us a new high, and it started pushing back to the downside. And what now happened? This is supposed to be a first opportunity. It's not as if this is supposed to be a first opportunity. This trade, among this trade, let me just tell you guys, at the end of the day, you guys will see I'm on this trade. Where I put my TP is here. because price, this is the other block. I think I even showed you guys yesterday. I've been on this trade since yesterday, yes. This is another block. This is daily D1 OB, other block. You see, after this other block, all right, you see this push to the upside. Why we were able to recognize, or rather the how you can recognize another block, I've already treated that. Go and watch the video, but I will still say few things so that you understand. Once you see push a retracement to the support level, a retracement to a support level, then the movement to the upside, you see a very huge, massive candle like this, a very big push. Just know that the only people, the people that has the financial willpower to push price like this, taking price from, let's say, from 100 to 500. Okay, taking price from $100 to $500 with just a push. The only people that can do all those things, they are financial body. And once they enter the market, those guys with big bag of money, once they enter the market and they want to trade, this is how they trade. And this is just a secret to let you know that they were involved in the market. They always leave a footprint. All right. Now, this is the push. Once you see a push like this, you know that is those guys. And once this push wants to start, it doesn't even take 2-3 minutes. The only thing is that as price is pushing back, they are offloading, they are what? They are locking in their order. Then once it gets to the level they want, then they will now push the price up. All right. Now, after this pushing of price to the upside, price created a high. Then price now started retracing again. It retraced, came back to that same level and tapped into the other block. What now happened? There was a massive rejection. This is a pin back. Since then, the price has been pushing to the upside. What do you think, guys? I think as a trader, as a professional trader, that we should have a new price. This push should violate this level, this high, for the price to give us another current price. And that is the reason why I'm on this trade. I'm holding it and it's going. All right. So now that we have identified all these levels, and we know that there is another block here, this is an opportunity. Let's say, for example, the price let's say, for example, you open your chart like this, then you now start price now start pushing. You see, once push like this, leaving a footprint, this one now becomes another block. So if you push price again, you see it's as if it wants to come back, but what happened? It did not come back. It now started going. It now created a high. Then this one here now engulfed this. Shows that sellers are now more than the buyers at this point. That means that is a sign of retracement. So price, we see, price now struck to this level. They dropped the price because the target was to come and interact with this level, and orders are already placed here, pending orders. All right. Immediately price go to this level, we see massive rejection. Buyers now rejected the price, and since then, we now see that the price has been going up. This is the level of price now. US 500 or S&P 500. So I'm expecting that this push to the upside should give us a new high. As simple as that. So since we have marked all this, I've been able to single out another block. Then we can now scale down to 4 hours. You see, this is 4 hours chart. And the 4 hours chart simply means that each candlestick here represents 4 hours. Each candlestick, one candlestick, 4 hours. One candlestick, 4 hours, just like that. All right. You see all these things that we mark, it then means that we are following, we are in tune with the higher time frame. We are in tune with the higher time frame. We know the direction. All right, you see all these things that we mark? Forget about all this one that is down here is too far. Like I told you guys, it's too far. All this one is too far. Yeah. As a day trader, you don't need to go too far. They are valid level, but it's too far. So once you open your chart, concentrate on the first, second support level. Just mark the first, second support level. Then you concentrate on that. That is where you find your opportunity. So you can now see, this is what I'm saying. It started pushing from here. I've been on this trade since it started from here like this, pull back, push, break, start breaking structure. You see, the push, pull back, push is breaking structure to the upside. But by the time I now discovered that, okay, instead of breaking structure to the upside, it failed, it started coming back. I will take my profit and I'm okay. But until that happens, if the sequence, the order flow still continue like this, I'm going to be holding until I now see otherwise. All right? Otherwise simply means, okay, now that instead of price breaking structure to the upside, it will now create equal highs or double tops and all that. So now this is 4 hours. The 4 hours now, we can now say, okay, let us refine the other block, bring it down to this place. Remember what I told you guys, the lower you refine, when you go to, when you scale down to refine the other block, that means the number of the pips of the stop loss gap will now be reducing. All right, that is even the major reason why we refine our other block. From the higher time frame, if I go back to daily, you discover that the daily, you see, the daily is something like this. All right, starting from here, the top to this level. All right, but if you scale to 4 hours, you now discover that you can now bring it to this level. You get? So look at it. For example, instead of 20 pips, maybe your stop loss pip will now be 15 pips. That is the idea. All right. That is why you must start from the higher time frame to do your analysis. All right. Now, if you want to read this one here now, you now discover that here price gave us double bottom. All right. Double bottom. What did I tell you guys? Double bottom, or you can call it equal price. Equal price. And once you see sign like this, price giving you or giving us equal price, you know that okay, it's time for trend to start changing. And what happened? It now gave us market shift here. You see, break of structure like this. And when it now got here again, created a high, it pulled back, violating this support level, market shift. Then price created a resistance, and it now pulled back to this point. When it now got here, what happened? It pushed to the upside like this, pushed to the upside. Now it's now trying to break this level. All right, this is where I told some of my guys that this level is what? A level that we should put an eye, because here is what? Where we will experience what we call market shift from this 4 hour. All right, market shift has not even, we've not experienced a market shift yet, because this was a last support, last resistance level. Until price breaks above it, market shift is not established yet. All right, so you can see price is rejecting from here. It shows that sellers are here. Sellers are here. So I will just be watching. But anything that makes price to break above this level is going to take out this high. As simple as that. So if, as it is now, you can refine to maybe 2 hours. If you want to go down again, you refine it. All right, you refine it to 2 hours. All right, then if you want to go down again to 1 hour, you refine it, you drop to 1 hour, you refine the 1 hour like this, the other block. All right, so if you want to go to 15 minutes, 30 minutes, you click, you refine. If you want to go to 15 minutes, you click 15 minutes, you refine. That means each candle represents 15 minutes. If you're on 30 minutes, each candle represents 30 minutes. So that is how to do what we call, you see that rejection on the higher time frame. On the lower time frame, it's a full candle. It just came, touch, then it now started flying back. All right, you can now see that on the lower time frame, market shift has already happened. All right, market shift has already happened. And that is one thing about trading. When you are on the higher time frame, you can still skate down just to come and look what is happening on the lower time frame. You skate down, you say, okay, change of character or market shift has already happened. Okay, it's coming. Because if after this change of character, you see market price pull back, push up, pull back. You see, this is a movement. All right. But on the 4 hours, it has not given us a change of character until this level is broken. I think you now see, when you skate there, you see all those break of structure, so many break of structure. But if you look at it on the higher time frame, it's just smooth. Until this level is broken, that means there is no market shift yet on the higher time frame. Even if you go to daily, you discover that until this level is broken, no market shift yet. All right, no market shift yet. This is an obstacle. Until this obstacle is taken out, once this obstacle is taken out, this level, that means we are going to get to this high. But the way I'm seeing it, it is possible because there is a momentum. All right, guys, you don't need to be scared. There is momentum. There is momentum. So that is practically how you do your top-down analysis. And the next thing you need to do, okay, you have singled out your order block, all right? You have singled out your order block, and all you need to do is just place your pending order. And what are all those pending orders? All those pending orders like buy stock, because now you are expecting that price will come tap here, then it start going up. That means you need to put pending order. That pending order is what we call buy limit order. All right. If it is a bearish trend and you are waiting for the bearish trend to come up, tap into the other block, that means you are going to set your sell limit order for you to now go down. So as far as I'm concerned, just like something like this, price like this got to this point, all right? Price got to this point, and at this point, it now dropped. All right, it now drops. So you are here, price is here, and you are waiting, okay, this change of character, waiting for price to pull back, then before it drops. So all you need to do as it's coming like this, set your order here like this. As it push to this upside, keep and put you in, then it start pushing to the downside. So that is how it is, guys. Man, I'm tired. It's not easy to teach anyway. But I hope you guys have grabbed the concept, all right? So that is how you do your top-down analysis, starting from the higher time frame, reading the structure, marking the structure, then you now start scaling down to the time you normally use to execute your trade. It's as simple as that. All right. But once we get to strategy, as I'll be teaching you guys strategy, then I'll now teach you guys how to enter the market in a proper way. The things you must see. All right. So I will now teach you strategy, the ways and the rules you need to set for yourself before you take any trade. Because this is money, you are using your capital. And what makes you a trader is the ability to spot an opportunity, then capitalize on the opportunity and make something out of the market, not giving your money to the market. Because if a trend is going up and you now place sell, it will come back and meet you, take your money. So that is, you need to always be very smart and know what you are doing at every point in time. So thank you so much. And on this note, don't forget to subscribe to my channel, guys. Subscribe to my YouTube channel. Share this video. Until I see you again, God bless you.